follow-through rally. What's up with the swings in jobless claims? Hey guys, it's Mortgage Mel and it's time for today's Mortgage Minute. Bonds are extending yesterday's post-Fed rally. And while this morning's jobless claims seem to be the catalyst, it's not the whole answer. The short answer is they're a little hard to interpret right now because we had such a late Thanksgiving. Here's what happened. Initial claims plummeted last week, but not because of a suddenly stronger labor market. It was simply the Thanksgiving effect. Seasonal adjustments didn't smooth this out properly because Thanksgiving usually falls around the 25th. And this year, the holiday came too late in the month for the adjustment formulas to do their normal job. Continued claims run on a 1-week lag, so this week's continued claims data is experiencing the opposite distortion. The result is a pair of numbers showing the biggest swings in years, one sharply higher and the other sharply lower. An obvious red flag that seasonal math, not real economic change, is driving the volatility. If we strip out the seasonal noise and look at the non-adjusted continuous claims, they're actually the highest in years. Bond traders may be paying attention to that underlying trend, not the flashy but misleading weekly swings. Why this matters for mortgage rates. As you know, mortgage bonds and mortgage-backed securities follow more closely the treasury yields, not this sort of Thanksgiving distortion. The underlying story is that the labor market seems to be weakening, which helps the Fed justify future rate cuts. And that in turn supports lower yields and better mortgage rate momentum. And today's rally isn't just about messy data. It's also part of a larger bond market reassessment. And that's because the Fed has really shifted their position to a more dovish or softer stance, more likely to see more rate cuts and short-term interest rates in the coming months. I hope this information helps. If it does, give me a like and a follow, and I hope you have a great day.